When most people hear the words, annual report, they immediately think of something boring, complicated, and only meant for accountants. Pages full of numbers, technical language, and long explanations that feel impossible to understand. But for Warren Buffett, annual reports are not boring documents, they are treasure maps. Buffett once said that if he had to choose only one source of information to make investment decisions, it would be company annual reports. Not stock tips, not market news, not analyst predictions, just annual reports. So the real question is, what does Buffett see in annual reports that most investors miss? Why annual reports matter so much to Buffett? Warren Buffett doesn't invest in stocks, he invests in businesses. And the annual report is the most honest conversation a business can have with its owners. Remember one key mindset shift. When you buy a stock, you are buying a piece of a real business. Annual reports tell you how the business actually makes money, where that money comes from, how management thinks, what risks the company faces, whether the business is getting stronger or weaker. Buffett reads annual reports to answer one simple but powerful question: is this a business I would be happy owning for the next 10 to 20 years? The Buffett approach: read like an owner, not a trader. Most people read annual reports like traders, skimming numbers quickly, looking only for profit growth, searching for short-term signals. Buffett reads like an owner. He wants to understand the business model. He studies management honesty. He looks for long-term competitive strength. This difference alone separates average investors from exceptional ones. The first section Buffett reads, Letter to Shareholders. If you want to read annual reports like Warren Buffett, this is where you start. Buffett has said many times, the most important part of an annual report is the letter to shareholders. Why? Because this letter reveals how management communicates, whether they are transparent or defensive, if they take responsibility for mistakes, how they think about the future. A great letter to shareholders is clear, honest, simple, direct. A bad one is full of excuses, overly technical, focused only on positives, avoids discussing failures. Buffett respects management teams that openly admit mistakes. In fact, he trusts them more. Red flags Buffett looks for in shareholder letters. Buffett is not impressed by fancy language. He looks for warning signs such as constant blaming of external factors, overuse of buzzwords, no discussion of risks, avoiding hard questions. If management cannot explain their business in simple language, Buffett assumes they don't understand it themselves. Understanding the business model before numbers. Before looking at any financial statement, Buffett asks, how does this company make money? Who are its customers? Why do customers choose this company over others? If he cannot clearly answer these questions, he stops reading. This is extremely important for beginners. Never analyze numbers before understanding the business. Numbers without context are meaningless. Buffett's circle of competence rule. One reason Buffett is so effective is that he stays inside his circle of competence. That means he only invests in businesses he can understand. He avoids industries he doesn't know deeply. When reading an annual report, Buffett quickly checks, is this business simple or overly complex? Can I explain it to a child? If not, he moves on, no matter how attractive the numbers look. Why most investors fail at reading annual reports? Most investors fail because they rush, they skip explanations, they focus only on earnings, they ignore footnotes. Buffett reads slowly, sometimes multiple times. He doesn't try to read many annual reports, he tries to read a few very deeply. Quality over quantity. Annual reports versus market noise. One powerful reason Buffett prefers annual reports is that market news is emotional. Annual reports are factual. News headlines create fear and greed. Annual reports create understanding. Buffett once joked that he feels like the luckiest investor alive because people trade on noise while I read reports in silence. Key lesson from Part 1. Before you move to balance sheets, income statements, or cash flow, read the letter to shareholders carefully. Understand the business model completely. Judge management honesty and clarity. Stay inside your circle of competence. If these boxes are not checked, stop right there. After understanding the business model and evaluating management through the letter to shareholders, Warren Buffett moves to the financial statements. But here's something most people get wrong. Buffett does not start by hunting for impressive numbers. He starts by asking a deeper question. Are these earnings real, sustainable, and repeatable? This is where the income statement becomes critical. Why the income statement matters to Buffett. The income statement tells the story of how much money the company makes, how much it keeps, how efficiently it operates. But Buffett knows one dangerous truth. Not all profits are created equal. Some profits look great on paper but disappear in tough times. Buffett wants profits that grow steadily, survive economic downturns, require little extra capital. Revenue. The first reality check. Buffett starts with revenue, not net profit. He asks, is revenue growing consistently over many years? Is growth organic or artificial? Does the company depend on one product or customer? Buffett prefers slow, steady revenue growth. Businesses with predictable demand. He avoids wild revenue swings. Companies dependent on trends or hype. Consistency matters more than speed. Quality of revenue. Buffett digs deeper. Are revenues recurring or one-time? Are customers loyal? Can the company raise prices without losing customers? This is where strong brands and monopolistic advantages shine. For example, Coca-Cola can raise prices slightly without losing customers. A commodity business usually cannot. Buffett loves pricing power because it protects profits over decades. Gross margin. A hidden competitive advantage. Gross margin tells Buffett how strong the business model really is. High and stable gross margins usually indicate strong brand, cost advantage, efficient operations. If margins fluctuate wildly, Buffett becomes cautious. He asks, why is this margin high? Can competitors easily copy it? If the answer is yes, he moves on. Operating expenses. Discipline versus waste. Buffett closely watches selling expenses, administrative costs, marketing spend. He prefers companies that grow revenue faster than expenses. Show operational discipline. A company that grows revenue but also grows costs at the same speed is not improving. Operating margin. The business engine. Operating margin tells Buffett how well management converts revenue into operating profit. Stable or improving operating margins are a strong positive signal. Declining margins raise questions. Rising competition, poor cost control, weak pricing power. Buffett always asks why, never just accepts numbers. Net income. The most misunderstood number. Many investors focus only on net income. Buffett doesn't. He asks, is this profit repeatable? Is it inflated by accounting tricks? Does it come from core business operations? One-time gains, asset sales, or accounting adjustments mean nothing to him. He wants clean, boring, predictable profits. Boring businesses often make the best investments. Earnings growth over time, not 1 year. Buffett never judges a company by 1 year. He looks at 5 years, 10 years, sometimes 20 years. Patterns matter more than snapshots. A company that grows earnings steadily, avoids big collapses, is far more attractive than one with explosive but unstable growth. Buffett's view on EPS, earnings per share EPS, matters, but only in context. Buffett checks, is EPS growing because the business is growing, or because of share buybacks hiding weak performance? He loves buybacks only if the business is strong, shares are undervalued. Otherwise, buybacks are cosmetic. The danger of adjusted earnings. Buffett dislikes adjusted earnings, non-GAAP profits, because if costs are real, they should be counted. Companies that constantly adjust earnings are often hiding weaknesses. Buffett trusts companies that keep reporting simple, don't manipulate perception. What Buffett ignores in the income statement. He ignores quarterly fluctuations, short-term analyst expectations, market reactions. Why? Because businesses are not built quarter by quarter, they are built year by year. A simple Buffett test. After reviewing the income statement, Buffett asks, if the stock market closed for 10 years, would this business still thrive? If the answer is yes, he continues. If not, he stops. Why this step eliminates most stocks. Most companies fail here because earnings are unstable, margins are weak, business models are fragile. Buffett doesn't need many winners. He needs a few great ones. Closing of Part 2, Natural Continuation. By the end of this step, Buffett knows whether profits are real, whether growth is sustainable, whether the business has long-term strength. But profits alone are not enough. In the next part, we will move deeper into the balance sheet, where Buffett checks debt risk, financial strength, whether a company can survive bad times. This is where weak companies are exposed, and strong ones prove their durability. After analyzing the income statement and confirming that profits are real and sustainable, Warren Buffett turns to the balance sheet. This is where he checks the financial strength of a business. Buffett often says that a great business with a weak balance sheet is a disaster waiting to happen. A balance sheet answers one critical question: can this company survive tough times without depending on luck? Why the balance sheet is so important to Buffett. The balance sheet shows what the company owns, what it owes, how strong its financial foundation is. Buffett uses it to assess risk, not excitement. He doesn't ask, how fast can this company grow? He asks, how badly can this company get hurt? Survival comes before growth. Cash, the first line of defense. The first thing Buffett checks is cash and cash equivalents. He asks, does the company generate enough cash internally? Can it survive a year or two with no profits? Strong cash reserves mean flexibility, stability, opportunity during crises. Companies with weak cash positions panic during downturns. Companies with strong cash positions buy competitors. Buffett loves businesses that never beg for money. Debt, Buffett's silent filter. Buffett is extremely cautious about debt. He believes debt magnifies both success and failure, but failure happens faster. Buffett checks total debt, debt trends over time, interest obligations. He prefers companies that can pay off all debt using a few years of earnings, have predictable cash flows. High debt in cyclical or unpredictable industries is a deal breaker. Short-term versus long-term debt. Buffett looks closely at short-term obligations, long-term liabilities, a dangerous sign, large short-term debt with weak cash flow. This creates refinancing risk, something Buffett hates. He prefers long-term debt with low interest, fixed-rate obligations, conservative borrowing, equity. Who really owns the business? Shareholder equity tells Buffett how much of the business truly belongs to owners. He watches equity growth over time, whether equity increases due to real profits. Negative or shrinking equity raises serious red flags. A business that constantly needs external capital is not self-sustaining. Retained earnings, Buffett's favorite line. Buffett pays special attention to retained earnings. He asks, has management reinvested profits wisely? Has retained earnings created more value over time? Buffett believes every dollar retained should create more than $1 of market value. If not, management is wasting shareholder money. Assets, quality over quantity. Buffett is not impressed by massive asset lists. He prefers productive assets, high returns on assets. He is cautious with heavy machinery businesses, asset-intensive industries. Capital-heavy businesses often struggle to maintain profitability. Goodwill, a subtle signal. Goodwill appears when companies overpay for acquisitions. Buffett checks, is goodwill growing rapidly? Are acquisitions strategic or desperate? Too much goodwill can signal overconfidence, poor capital allocation. Buffett prefers organic growth or carefully chosen acquisitions. Return on equity, ROE, a Buffett favorite. ROE shows how efficiently a company uses shareholder money. Buffett looks for high, consistent, sustainable ROE, but he checks one thing carefully. Is ROE high because of strong business, or because of high debt? High ROE with low debt is gold. Liquidity ratios, quiet strength. Buffett uses liquidity ratios to assess short-term survival ability. He prefers businesses that don't depend on refinancing, can meet obligations easily. Liquidity equals peace of mind. What Buffett avoids immediately. Buffett walks away from companies that depend heavily on debt, require constant refinancing, have unstable balance sheets, can't survive a downturn, no matter how exciting the story sounds. A Buffett reality check. After reviewing the balance sheet, Buffett asks, would I feel safe owning this business during a global crisis? If the answer is no, the investment ends there. Why this step eliminates most companies. Many companies look profitable, show growth, but collapse under stress because they are over-leveraged. They lack financial discipline. Buffett wants businesses that endure, not just grow. Closing of Part 3, Seamless Continuation. At this point, Buffett knows the business is understandable, profits are real, financial strength is solid, only one major piece remains. In the final part, we will examine the cash flow statement and management capital allocation, where Buffett confirms whether profits turn into real cash, whether management deserves trust. This is where truly exceptional businesses reveal themselves. After understanding the business, analyzing the income statement, and testing financial strength through the balance sheet, Warren Buffett moves to the final and most decisive stage of reading an annual report: cash flow and capital allocation. Buffett believes that earnings are an opinion, but cash flow is a fact. This is where many companies fail, and where truly great businesses stand out. Why the cash flow statement is critical. The cash flow statement answers one powerful question: does this business actually generate cash, or just report profits? Buffett wants businesses that convert profits into real cash, generate excess cash year after year, require minimal reinvestment to grow. A company that looks profitable but struggles to generate cash is a major red flag. Operating cash flow, the lifeblood. Buffett starts with cash flow from operations. He asks, is operating cash flow consistently positive? Does it grow along with earnings? Strong businesses generate cash naturally, don't depend on financing or asset sales. If operating cash flow is weak while profits look strong, Buffett becomes skeptical. Free cash flow, Buffett's favorite number. Free cash flow is what remains after running the business, maintaining assets. Buffett loves companies that produce large amounts of free cash flow, don't need constant reinvestment. Free cash flow gives management options: pay dividends, buy back shares, reduce debt, invest in growth. The more free cash flow, the more control the company has over its future. Capital expenditures, growth or maintenance. Buffett examines capital spending carefully. He asks, is the company spending to grow, or just to survive? Great businesses require little capital to maintain operations, earn more without constantly reinvesting. Capital-heavy businesses often struggle to compound wealth. Cash flow versus net income. Buffett compares cash flow, net income. Over time, they should move together. If profits rise but cash doesn't, earnings quality is questionable. Accounting manipulation may exist. Consistency is key. Management capital allocation. Once Buffett confirms cash generation, he focuses on how management uses that cash. This is where leadership quality truly reveals itself. Buffett evaluates dividends, share buybacks, acquisitions, debt management. Dividends, signal, not goal. Buffett doesn't demand dividends, but he respects consistent, sustainable payouts. Dividends signal confidence, financial stability. However, reinvesting cash wisely is often better than paying dividends blindly. Share buybacks, smart or wasteful. Buffett supports buybacks only if shares are undervalued, the business is strong. Buybacks at high prices destroy value. Buffett loves companies that buy back shares opportunistically. Think like owners. Acquisitions, discipline over expansion. Buffett watches acquisition strategy carefully. He avoids companies that overpay for growth, chase size instead of value. Smart acquisitions strengthen competitive advantage, improve long-term earnings. Bad acquisitions destroy decades of value overnight. The economic moat. Buffett's final qualitative test is the economic moat. He asks, what protects this business from competition? Moats include strong brands, network effects, cost advantages, switching costs. The wider the moat, the safer the investment. Risk. Buffett's true definition. Buffett defines risk as not knowing what you're doing. He avoids complexity, unpredictable industries, speculative growth stories. Simplicity equals safety. Buffett's final annual report checklist. Before investing, Buffett confirms, I understand the business. Management is honest and capable. Profits are consistent and real. Balance sheet is strong. Cash flow is reliable. Capital allocation is intelligent. Competitive advantage is durable. If even one box is unchecked, he walks away. Why Buffett needs so few investments? Buffett doesn't diversify excessively. He believes wide diversification is only required when investors do not understand what they are doing. Because he studies deeply, he invests confidently. The power of patience revisited. Reading annual reports is slow work, and that's the advantage. Most investors won't do it. Buffett wins because he is patient, he is disciplined, he thinks long-term. Final thoughts, strong conclusion. Reading annual reports like Warren Buffett is not about intelligence, it's about discipline and mindset. Anyone can learn it, few are willing to practice it. If you read carefully, think like an owner, focus on long-term value, you will already be ahead of 90% of investors. Warren Buffett didn't build wealth by predicting markets. He built it by understanding businesses deeply and trusting time.